What's going on, everybody, and welcome back to bootcamp day number 2. In today's bootcamp, we're going to be going over candlesticks, and I know this is very basic information. However, I do highly encourage you guys to stick all the way through because I am going to be discussing some advanced things that you do need to know about candlesticks. But real quick, as always, before hopping into the bootcamp, make sure you guys do your daily check-in, comment down below, letting me know that you're still rocking with me and that you're going to make it all the way through this bootcamp. And while you're at it, also make sure to hit that like button. Remember, the more engagement these bootcamp videos get, the more bootcamp videos that you guys are going to get. So engage with the video and let's hop into it. All right, so starting off with just very basic candlesticks, okay? Looking at these two examples right here, a green candle is implying that price closed higher than where it opened. A red candle is implying that price closed lower than where it opened. So if we're looking at this green candle right here, price opened at this lower green shaded area right here. Now what the wicks are telling us is this is how high or how low price went during that candle. So at one point, price dropped all the way down to here, and then at one point, price was all the way up here. But by the end of this green candle, price closed all the way down here. And this can actually be very useful information. Reason being, when price opened here and dropped down to here, this was a red candle at one point, but buyers drove price back up, eventually all the way up to here. So at one point, it was actually a very bullish candle. But then later in the candle, sellers came in and drove price all the way back down to here. So at this point, buyers and sellers are both showing a presence in the market. And we'll start talking about how to read the wicks here in a little bit. But for now, again, price opens here, goes as high as here, as low as here. But at the end of the green candle, price closes right here. Now, as far as a red candle, price is actually going to open at the upper red shaded area. And just like the green candle, the wicks imply that price went as high as here, as low as here, but at the end of this candle, price closed down here. So price closed lower than where it opened. And at one point, this was a green candle because price opened here and pushed up to here. At this point, it was green, but sellers drove price all the way down to here. And then again, at one point, this was a more bearish candle, but buyers came into the market and pushed price back up into here. Again, very simple stuff. But now here's where it starts to get a little more advanced. Say we have a green candle that looks something like this. Just because it's a green candle and price closed higher than where it opened does not mean it's bullish. Or let's say that we had a red candle that closed like this. This does not imply that it's bearish just because price closed lower than where it opened. We have to pay attention to the wicks. And that's personally what I do in my trading. What's more important to me is the wicks rather than the body. Now, why is this? So at one point, if we're looking at the green candle, for example, price opened right here, dropped down to here, and then they drove price all the way up into here. So at one point, this green candle looks something like this. Ignore that little wick right there. But at one point, it was a very solid green candle. But by the end of that green candle, sellers drove price all the way back down into here. So to me, actually, this is very bearish. And the longer this upper wick is, the more bearish it is. Because again, it was a very solid green candle, but then sellers drove price all the way back down to here by the end of that green candle. So this is actually a very bearish candle. Same thing with this red candle over here. Yeah, price opened here, but at one point, this red candle was very, very bearish all the way down to here again. Ignore that little wick. But by the end of this red candle, the buyers drove price all the way back up into here. So because this was a very bearish candle at one point, but buyers came into the market and made up a lot of that ground and drove price all the way back up into here, this is actually a very, very bullish candle. And again, the longer this lower wick, the more bullish it is to me. Now, when we start talking about key levels in the next few lessons, it's going to make a lot more sense. Because if we came down to a support level and reacted like this, that's even more bullish to me because buyers are coming in at the support and driving price higher. Or if we had a resistance and this green candle came up, smacked it, and sellers drove price all the way down, again, that's even more bearish to me. So we'll be talking about how to find key levels within the next few lessons. But when you're sitting there reading candlesticks, again, the most important thing personally for me is going to be these wicks, because the wicks are going to tell the story. They will let us know how strong or how weak buyers and sellers are in the market. Now, again, I will short candles that look something like this all the time, but it just really depends on where are we trading in the market. And once I show you guys how to find key levels, piece together the price action with the volume, it's all going to make sense. But for now, again, the wicks are going to be the thing that tell you the story, and they are going to be the most important when price is trading at a key level. So if you guys are taking notes, pay attention to the wicks when price is at a key level, because that is going to let you know are buyers or sellers truly in control at that key level. So let's just go ahead. Let's start looking at some candles here on Tesla. That way we can just break down the basics of candlesticks. But if we're looking at Tesla yesterday, very bullish candle right off the market open. Price opens here, dips down, push price all the way back up into here. Very, very bullish. At this point, solid green candle, very bullish. This candle right here doesn't imply that price is going to reverse. It's not telling us price is bullish. It's not telling us it's bearish. It's just a basic red candle with equal upper and lower wicks. Now the very next candle, very bullish, price opens here, drops to here, boom, new high day. Same thing with this red candle, does not imply that price is going to reverse whatsoever. No long upper wicks, not trading at a key level, very weak volume. Very next candle, bullish engulfing, goes into a new high day. Now I do want to talk about this candle right here. Now when we talk about the key levels, piecing together volume plus the price action, if Tesla were to come up into a supply zone, resistance zone, Fibonacci zone, and we hit it like this and got a candle like this, that is 100% a trade that I would take to the downside. But now keep in mind, Tesla is not trading at a key level at this point, so I would not short this 5-minute candle. I would only short it if we were trading at a key level. But the reason why I would, if we hit a key level, was we have a smaller green candle, nice long upper wick, and an elevation in volume. So as we were talking about over here, I will short candles that look just like this all the time. It all depends on where we trading. So if price came up into a resistance level right here and we hit it, because again, at one point this was a solid green candle, something like this, sellers drive price back down, we could assume if we hit a reject level that a majority of this volume came in on the sell side. But because Tesla was not trading at a key level and not rejecting a key level, we would not short it. Very next candle, pretty bullish. Price tried to drop, buyers drove price back up, and now we get another bullish engulfing candle, driving price all the way back up. Same thing with this, open here, drop to here, boom, another new high day. Open here, drop to here, buyers drive price all the way back up. Again, super bullish. And then eventually we get a very, very large aggressive green candle to the upside before price pulls back, creates a bull flag, and then from there, it's just kind of a steady run to the upside from there. But that's really how you're going to start looking at price action. When you're looking at the wicks, it's going to be the most important when price is trading at a higher time frame key level. But that's just the basics of candlesticks. Again, on a green candle, price opens here. Sometime throughout that candle drops all the way down to here. Sometime throughout the candle goes all the way up to here, but at the end of that green candle closes right there. With a red candle, price opens at the upper shaded area. Sometime throughout the candle goes to the upper wick. Sometime throughout the candle goes to the lower wick, but eventually closes at the lower portion. And the way that you're going to differentiate between a bullish candle and a bearish candle is always going to be through the wick. How aggressive is that wick? Because that will tell you are buyers or sellers in control. But that is going to wrap up bootcamp day number 2, the basics of candlesticks. Again, we're going to talk more about volume and finding key levels, and then we're going to have a video where we piece everything together. So if you guys did enjoy bootcamp day number 2, which I actually had to record 2 times and my throat is killing me, make sure to hit that like button, comment down below, let me know that you guys are still rocking with me, make sure you guys are doing your daily check-in. Other than that, everybody have an amazing rest of your day, and I will see you guys in bootcamp day number 3.